guess when the stock market goes down significantly, the first thing people want to do is panic. I guess the emotion kind of sets in and people act in ways that they probably know they shouldn't, but it's very hard to not act those ways. So I think the first thing you need to do is take a step back and really not panic. And I think the first call you need to make is to your investment advisor to see whether or not what's going on in the stock market actually affects your situation or your investments. Because there are many instances where, for example, let's say the price of oil is falling, but you may not own any oil investments. So you may think the world's coming to an end, but really you're okay and you're doing a lot better than you might actually think. So once clients figure out and agree that it's definitely not time to panic just because the market might be down a few hundred points, the next question becomes, what do we do at this time? Do we sell certain investments or do we use this as a buying opportunity? As I've said many times, and I recently wrote a book called Buy Low, Sell High, we want to look for these types of opportunities to actually make an investment or add new money to the portfolio, buy things on the cheap. So how do we go about doing that, which is a great question. And really, I think it comes down to looking for good quality investments at a cheap price. And if you have investments that are not performing well, and perhaps what's going on in the market is due to certain areas of the economy, perhaps those are the investments that you may want to get out of and move that money into other areas that you think will perform better in the future that are cheaper today. And so what I think you want to do is make subtle changes within the portfolio to try and move assets to areas that have a good story behind it, and perhaps take money away from some of those areas that the story may not be intact right now. I think having a plan definitely helps. Obviously, there are long-term plans, so setting targets for retirement and obviously buying investments that will get you to your goals or to get you to reach your goals, but also having a plan with respect to trading. In my opinion, the days of the buy and hold strategy are long gone. The market is way too volatile today to have a plan of just buy an investment and hold on to it even if it goes down, and eventually you will make money. I think those days are long gone. I think what you want to do now is buy a good quality investment, set your targets, understand what that investment is going to do for you. And that's my job. When I buy investments from my clients, I explain what that investment is going to do for them, what in my opinion, it's going to do for them. Sometimes it works out and sometimes it takes a little bit longer to work out. But overall, we set our targets for that investment. When those targets are reached, we then reevaluate. Perhaps that's the time to sell. Perhaps that's the time maybe to even add more. But that's how having a plan can help. It's not as simple as just buy everything that's the cheapest you could find and then, throw caution to the wind and hope and pray. It's buying good quality investments, setting your targets, and executing that transaction. And hopefully by doing this over the course of many years, you will basically reach your retirement goals or whatever goals you have set for these monies. The best way for people to protect themselves against market volatility is in my opinion, one way, and that's diversification. Everybody knows about the term diversification. It's been preached to everybody since they started investing many years ago. But really, in my opinion, it is the best and the most cost-effective way of protecting your investments when times are difficult and volatile. Having a bit of money invested in many different areas will help protect you. Today, many people think that if you're in low-risk investments, for example, that's a way to protect your money. But they don't realize that low-risk investments also have risks associated with them. One of them in particular would be interest rate risk. Interest rates rise. Many of these low-risk investments are interest rate sensitive, and their values will fall. So I don't think, especially in times when interest rates are very low, it's as simple as buying all low-risk investments and you can sleep at night. I think the best way to protect your money during volatile times, whether it's interest rate volatility, whether it's stock market volatility, is have a good mix of different types of investments in different areas of the market, different sectors, geographically spread out throughout the world. And I think that is the best way to protect. And again, in my opinion, that's where your investment advisor can come in to help you build that nice diverse portfolio out of investments that are monitored on a regular basis for when they reach those targets. And you can either buy or sell, or buy more or sell. But that is really the plan. The plan is to build that nice diverse portfolio.